The European Central Bank decides on interest rates Thursday this week. Will the meeting be a damp squib, or will the Governing Council begin to open up on its thoughts on how and when it will begin the long path of tightening? Marc Ostwald joins us now from ADM Investor Services. Marc, welcome. Stick or twist this week?
Oh, they're definitely going to stick. I think the sort of parameters of what they want to achieve this week is they need to start preparing markets for tapering. And it needs to be a very gentle process because it's a much more complex process than, say, for the Bank of Japan, the Bank of England or the Fed, because obviously there are a lot of different government bond spreads here involved, and the ECB's exit from purchasing government bonds in the Eurozone is going to have a differential impact. Therefore, they need to prepare this process very, very carefully. So I think what they'll do this week is basically say, as we said, we're going to be sticking with the current program of 60 billion euros a month until the end of the year. We are now sending off the various subcommittees to go and see how we look at the whole process of tapering, to engage with the marketplace to see what risks they see, and then to come back and report the council in the context of what the council's outlook. And obviously we will, in September, have a much clearer view of what our most recent economic forecasts are, above all for inflation, and what the outlook there is and how that impacts our tapering or our QE program and the tapering thereof.
What is the market pricing in at the moment, either equity markets or the euro or the bond markets? What are they pricing in from not just the European Central Bank but other central banks around the world?
Well, I mean, they're not pricing anything in from the Bank of England, particularly not after those inflation data.
Right.
For the ECB, let's be honest about it. The ECB may be starting to taper, and you might see a steepening of government bond yields, but the market basically is still looking at the end of 2018, so another 18 months away before they start adjusting interest rates. And to some extent, one might say, well, then why has the market managed to get itself so long of euros, above all against the dollar? And I think that's a very good question, because in the meantime, we may play down how much the Fed's going to raise interest rates, because this so-called transitory downturn in inflation may prove to be less transitory, or rather more long-lived. But they're more than likely to at least do another 2 or 3 rate hikes by the end of next year, before the ECB has even entered it. So you're talking about a widening interest rate differential, which at the end of the day, when the market's got itself quite long of euros, people are going to have to ask themselves the question, would they rather have the interest that they can earn in dollars, which is already considerably more, or are they going to chase down the euro until we get to levels at which the ECB might actually say, actually, we don't have a euro target, but obviously the strength of the euro is going to bear down on inflation even more, which means it's an effective tightening for us, and also likely to bear down on CPI, pushing out our timeline for raising rates. I don't think the market's quite thought through all of this.
Yeah, there's a lot going on at the moment. Of course, the rise in the euro has done some of the heavy lifting, as you suggest, for the ECB. The ECB as well is close to ownership of 33% of some of the bond markets it's buying into. Some of the QE programs have meant that so much now has gone onto the balance sheet of the ECB, they can't buy anymore. That's a difficult one, isn't it, as well, for the ECB?
This is one of the reasons why it actually needs to start laying out its tapering plans, because it knows it already has some technical hurdles to get over, which are going to be very big, because the politics of, there are some people who have suggested they could adjust buying according to the capital key. Well, they're already not quite adhering to it, particularly in the case of bunds. And beyond that, they do need to take this into consideration, because at the moment the pressure's really on, because the worst thing in the world would be to carry on with the QE program, and then people saying, but you're not actually managing to buy the bonds. Why haven't you made the adjustment? Why haven't you admitted to this? It would be effectively a policy failure, which I think would send a very negative signal to financial markets.
One final question is, when the ECB does start the tapering program, when it does start to unwind this ultra loose monetary policy, the market's going to say, okay, we've now got a completely different situation here. You were talking earlier about buying the dips constantly in the markets at the moment. The markets yet haven't really understood the ECB's serious, perhaps maybe about its program of tightening. And when it does, are the equity markets going to tumble out of bed?
I think there's certainly a risk, and I think there's a little bit of gaming going on, both of the ECB and above all of the Fed, that the market is basically going, here's all this hawkish rhetoric you're saying, that we don't really need all this excess liquidity that you've been pumping in. Well, go on, start to remove it and just watch how financial conditions tighten. So I think that markets are basically saying we're not going to change our way until you actually make the admission, which the central banks can't make, that actually there are distortions in financial markets, particularly in pretty much all asset classes, due to the quantitative easing of the various central banks, which the central banks are now becoming rather afraid of, that you could end up with a cascade when they all start to head for the exit.
And is it possible to calculate what that means, let's say, for the equity markets? I mean, we're talking 10, 20, 30% of equity markets being built up because of QE?
I think that the golden rule here is what one has to think about is central banks have been, for instance here, in the Eurozone, the ECB has basically bought net all the BTPs that have been issued by Italy, and someone is now going to have to, once the ECB starts tapering, in the marketplace is going to start having to take that supply down. And so that naturally puts a lot more upward pressure, particularly on long-term interest rates. And it's a question of how well the ECB can control that, so you don't see a sudden ballooning in Spanish, Portuguese, Italian, or indeed some of the semi-core government bond yields, because that's certainly something they won't want to see, and they will get a lot of complaints about from the politicians, even though the ECB has prepared those politicians very well.
That would seem to me to be at least negative for the equity markets. How about the euro? Negative?
I think not necessarily negative for the euro. I think the most negative aspect for the euro is, particularly versus the dollar, not necessarily so much against the yen, is the widening rate differentials. I think with the yen, eventually we're going to get to a situation where all the other central banks are tightening, and the Bank of Japan is still a million miles away from hitting its inflation target, and is the last man in the queue. And you see with widening rate differentials, foreign exchange traders at the end of the day are fairly simple folk. If they see some carry, particularly widening carry prospectively, they will go to the currency with the better carry in it.
Yeah. Okay. Look. All right, Mark. We'll have to leave it there. But thanks indeed for joining us. Marc Ostwald from ADM Investor Services with his view on the ECB and more. Watch out for the ECB decision at 12:45 UK time this coming Thursday.